Welcome to Module 3 of Note 4. Today, we're going to talk about the ICT breaker block. So the bearish breaker block. What's the bearish breaker block? This is a bearish range or down close candle in the most recent swing low period to an high being violated. Buyers above this low and see this low violated will look to mitigate the loss by going short when price return back to the swing low. This setup can be used when considering a bearish trend. Now, this is the diagram I used to explain. So now, it is the bearish range or down close candle in the most recent swing low period, that is before the high was taken. Buyers that bought this low and see this low violated, now there are buyers who have huge capital that might have bought from here. You know, when you buy here, you want to put your stock below this low. So now once price runs down to take out this low, they will be in a losing trade. So they will look to mitigate the loss by going short when price return back to the swing low. So once price return back to this low, this was where they entered initially, they will mitigate their losses by entering in a sell trade. This setup can be used when considering a bearish trend. So the bearish breaker block is used when considering a bearish trade. Now I'll go over this diagram again. We can see that this high was formed. So this range here is very important. Why? If we see the buy stops being taken above the high, price breaking structure below the market, we expect that once price return back to this range, from this high to this low, or the last down close candle before this high was taken, we expect that price will run down bearish. Because why? Buyers who might have bought into this run here will seek to mitigate their losses, because if you buy here, we all know this is very simple. If you buy here, what happens? You want to put your stop loss here, or even here once you see price rallying. So if market runs down, takes you out, you will want to enter again for a sell if price returns back to where you initially bought. So this here explains the whole concept of the bearish breaker block. The reverse is the same for the bullish breaker block. This is a bullish range or up close candle in the most recent swing high period to an old high being violated. Sellers that sold this high and see this high violated will look to mitigate the loss by going short when price returns back to the swing high. This setup can be used when considering a bullish trade. So you can see here that this low, this is the most recent swing low that was formed before the sell stops were taken. Now, once price rates the high here above the market, sellers who might have sold this range will seek to mitigate their losses once price returns to this point here for a buy. So I hope you understand. So there are two things involved: taking of liquidity, break of structure. Once price returns, you expect price to rally in the other direction. So now I would like to explain the concepts properly behind the breaker block. Usually, breaker blocks are formed finding resistance or support in higher time frame institutional levels. So for a bearish breaker block, you want to see it forming at a higher time frame resistance level, either a monthly or weekly order block, or price taking liquidity above the market. Now, this range here that was formed, you can see this range here. Let me just draw it out. This range here that was formed. If market rallies up to take the stops above the market and then runs down to break structure, you would want to anticipate that once price returns back to this level, market will sell downward. So you as a retail trader is given the opportunity to sell, because you might not have anticipated that market wants to change direction, because this is a shift in market structure here. Market rallying and break structure to the downside. So once market structure has been broken to the downside, you anticipate that if price should return back to this level, this range here, price should sell, because As price was rallying, hit like this, there's no way to tell that at this point, markets will shift direction. So if you see markets shift direction at this point, you would expect that once price returns to this level, this range here that we see, which we term the bearish breaker block, price should sell. Now, we either use this range, let me clean this. We either use this range or we use the last down close candle that was formed before the stops were rated. So this whole move here represents repricing of the market because market has changed direction. Market was rallying upwards like this, and then it has repriced lower, breaking structure to the downside. Mind you, this repricing occurs after buy stops has been taken. You don't want to see something like this and the market breaks structure to the downside because the buy side hasn't been taken yet. But if you see something like this where the buy side has been tagged, has been taken, and then there's a break of market structure, you want to term this range here a breaker block. Now, once price should return, market should sell downwards. So this break of market structure has indicated that there is a shift in market structure. So if price should return back to this range, it creates new opportunity for a sell. So we have it here. This is the point. This is the range we term the bearish breaker block or the last down close candle that was formed here. So the reverse is the same as well for the bullish breaker block. We want to see a run on stops. This is sell side liquidity. The moment we see a break of market structure after sell stops have been taken below the market, we expect that if price should return to this level, you should anticipate a buy. So this here is a repricing. I hope we get it clearly. And here we have an opportunity for a buy. Now let's look into the charts. What does a breaker block look like? Now you can see how liquidity was tagged there, and then there was a break of market structure. This range here is our breaker block. Or you could use the last down close candle that was formed before liquidity was taken. So after market structure has been broken to the downside, we expect that if price should return back to this level, market should sell downwards. So it's very simple. This is what we are seeing here. Something like this. Market taking liquidity, break of structure to the downside, market returns back to this level, should sell. This is the bearish breaker block. So we can see here, this is the bearish breaker block. This candle here is the last down close candle before liquidity was taken. So we can use this whole range here, but we can also pick this candle here. So market should not continue rallying above the market. Why? Because liquidity has been taken. Then for the bullish breaker block, you can see how liquidity was taken here, and then market broke structure to the upside. So once market is returning back to this range, so you can see consecutively up close candles. So we can classify these candles here as the bullish breaker block, and you can see how market reacted from it. Very, very, very easy to see. Now there's another opportunity here again. Let me draw it out. You see this range. So as soon as market broke structure, this candle here was what broke market structure here. But before the break of structure, you can see that liquidity was taken here. Market took buy side liquidity, then broke structure with this candle. Then this candle here returned immediately. Even this candle gave another opportunity again, finding resistance in this breaker block before rallying downwards. So you will need to go to the chart and look for these things so that you will be able to identify them easily. Now, if you want to learn more about the breaker blocks and how you can use it as a strategy, please watch the next video you see by the right corner of the screen. And as always, I wish you a good luck and good trading.